I'm Shazana Mokhtar with Keith Kam and Aisali Ayob. All right, for more insights on what's moving international markets, we have on the line with us Michelle Schneider, Chief Strategist at marketgauge. Mish, good morning. Thanks so much for joining us today. So the market rebound in the U.S. that we saw on Wednesday disappeared today after the White House announced tariffs of 145% on Chinese imports. How are investors pricing in the effects of these eye-watering tariffs?
Well, it's very confusing to come to any cohesive conclusion because we hear headlines. I mean, obviously the China headline is one, but we're hearing a lot of other headlines about countries that are willing to make deals, countries that are getting rid of any thought of retaliatory tariffs. Of course, the 90-day moratorium that Trump announced yesterday, U.S. time. And so China may be, the beacon of really what's going to happen with future policy. There is somewhat of an attitude here that the biggest problem with this is that China will not buy our debt, which will also force other countries to do the same, that our dollar will continue to go down. Right now, it's sitting kind of at a major support level at around 100. And so essentially, this could all be another massive negotiating tactic, and this can kind of resolve to a point, or it may be sort of a sea change in terms of China as number two economy picks itself up because they've had now a history of pulling up from a massive level of poverty now to a much more prosperous country than they used to be, say, 20 years ago, while the United States, that has been really in a level of prosperity, could actually suffer. We don't know, but I do not believe that Trump will allow the U.S. to go down much more in terms of its prestige or even in terms of how it handles its own people, even though the isolationist policy is right now his biggest talking point.
Mish, just some insights from yourself. You're a chief strategist at marketgauge. How do you strategize in situations like this where information can just change from one end to another and give you whiplash? Do you have whiplash?
I think we're all exhausted, right? I mean, it's been crazy. To say, oh, it only went down 1,000 points when it was up 2,000. I mean, the fact that you can even talk in numbers like that, you're talking about the way commodities would move during massive events, not equities. And so, yeah, so basically what we've done is this for our clients. We've raised a lot of cash. When the market started to turn down, actually, it was the consumer sector that was kind of giving us the first clue. And that was really at the end of January, February. That's when we started to get more defensive and really stop taking on a lot of new positions and instead put stop in our existing positions. So at this point in time now, we have, depending on what account you're looking at, anywhere from 50 to 90% cash. And that's where you want to be right now. Obviously, and you and I have talked on this show several times, I've always been a fan of gold and silver, and that turned out pretty good, right? So naturally, there should be positions continuing in gold. As far as the rest, we're watching. So there's always opportunity, and there's going to be areas I think that will hold up better than others. Defense, some healthcare, still other commodities now starting to look a little bit more attractive. We're looking at some of the made in America type situations. There are things that are outperforming, but you've got to really be careful because if we have another massive liquidity event with another 2,000 followed by another 2,000 point drop, nothing really survives. Obviously, even gold got hit last week.
Mish, earlier you were mentioning about the U.S. dollar and how it's taken a hit in all this uncertainty. We are seeing traditional safe havens like Treasury bonds and U.S. dollar no longer really working as they used to amid all this volatility. What explains this current phenomenon?
Well, it is a phenomenon, right? And so essentially, partly I think is because the Fed has really stayed very careful about their feelings about lowering interest rates. And so you're not getting support like we would from Federal Reserve in a declining market, possibly recession. Number one. Number two is people are not buying our debt And so that's putting a pressure on it as well. And number three is, at this point, there is absolutely little confidence in the administration to be able to avoid a debt crisis on the path it's going right now. Now, that isn't to say that the bonds could turn around on its own, but we want to see it happen naturally as opposed to forced policy by the Fed, some emergency cut, because I think that would send even a worse signal to the market than now the Fed is afraid.
So FOMC minutes and inflation data were released yesterday, with CPI coming in lower than expected at 2.4%. Given that this inflation data is based on pre-tariff hikes, does it have any bearing?
I would say probably not. I mean, first of all, we have been seeing this. It's still above the 2% target. So let's start with that on the Fed, which is why the Fed is not going to give up the sticky inflation. But it doesn't reflect, as you just said, not only what could happen with tariffs, supply chain issues, and of course, rising prices. We're seeing it already in a lot of the grains, for example, besides the metals. But it also, the drop mainly was in airline fares. And so is that really representative of the whole economy? Well, yes and no. It's not necessarily representative of inflation purely, but it is representative of the fact that consumers are nervous. And of course, now tourism is being impacted in this country as well, which is about 9% of our gross domestic product. So yeah, it's a dicey situation wherever you look.
Mish, you were talking about commodities just now, and you mentioned gold and silver. And it's just occurred to me, gold has surpassed its new all-time high. What is there still an upside there? Are you still bullish about it?
Well, our initial target was at about 3,000, and then we had a little teeny bit of a correction, and now obviously we're over 3,200, so it's continuing to go up. Yeah, I mean, literally, if you look around the board, other than volatility, which is self scary as it measures fear as an instrument to trade for safety, gold is the only thing right now that foreign countries feel comfortable in, and obviously now it's caught on with speculators here in the U.S. But 3,400, I don't know. People saying 4,000, 5,000. I've heard 40,000. I mean, that's sort of crazy. But until things calm down, gold is where it's at. What's interesting about silver is that we have also a widening ratio between the gold and the silver. So right now, gold is trading at 102 times the price of silver. And so that's another that's kind of where my focus is, even more on the price of gold right now, because we want to see that ratio not get too far, because silver is an industrial metal. And again, another point towards possible recession, or what we're in right now, stagflation. But if silver starts to catch up a little bit and that ratio flips, let's say breaks down under 94, it's right at 102, maybe that would be the first sign also of not just stagflation, but more hyperinflation while the economy stagnates. So you got to watch very carefully.
Mish, while we have you on the line, we are on the cusp of the next earnings season over in the U.S. I think the major banks are set to announce their earnings tomorrow. What are you going to be expecting in terms of comments or statements from the bankers?
Well, a lot of focus, of course, is going to be on the forward guidance as opposed to the actual numbers, because like the CPI we just talked about, it doesn't reflect the tariff situation right now. So already we saw Walmart come out and say they're not going to give forward guidance. The same thing with Delta Airlines. And Jamie Dimon has certainly been making his comments. So I suspect that tomorrow after JP Morgan, which I think is the first bank to report, will probably have very much the same. I mean, who could possibly say anything more definitive at this point? So I can't imagine we'll hear anything other than, we're not going to tell you what we think going forward because we don't know.
Mish, thanks very much for speaking with us. That was Mish Schneider, Chief Strategist at MarketGauge.